Hello everyone, in this week we will study lecture 8 in Managerial Finance. The topic is this week including agency theory and corporate governance, dividend policy and share repurchases, and capital structure theory. First we look at what is an agency relationship. So an agency relationship arises whenever one or more individuals called principals hires another individual or an organization is called an agent to perform some service and then delegates the decision-making authority to that agent. So in modern corporate business, we see the principal is the owner, while the agent is the manager. So what's the problem with that? And when would an agent problem exist? So a potential agency problem arises whenever the manager of a firm owns less than 100% of the firm's common stock or the firm's borrows. If the owner or manager owns all the stock, the owner or manager bears all the cost. If there are also outside shareholders, they bear some of the cost due to the owner or the manager's perks. The modern corporation exists because they have many shareholders, none who own a controlling interest in the company. So the decision-making delegated by shareholders to an elected board of directors. Then the board of directors delegates most of the decision-making to hired executives who then hire other employees and delegate some decision-making. Potential agency conflict between shareholders and managers exist. There are 6 potential problems with managerial behavior. For example, expend too little time and efforts. The managers tend to be lazy. Consumes too many non-pecuniary benefits, including luxury cars to increase their own salaries. Avoid difficult decisions out of loyalty to friends in company. Reject risky positive net present value project to avoid looking bad if project fails, and take on risky negative net present value projects to try and hit a home run. Or avoid returning capital to investors by making excess investment in marketable securities or by paying too much for acquisitions. Or the message information releases or manage earnings to avoid revealing bad news. So we can see that there are huge problems with the agency conflict. So what you need to do is to have a corporate governance. So corporate governance is the set of laws, rules, and procedures that influence a company's operations and the decisions made by its managers. Which is we always talk about the sticks and the carrots. Chapter 11 is talking about the dividend policy. So what is a distribution policy? So the distribution policy defines the level of cash distribution to shareholders and the form of distribution in forms of dividend or stock repurchase and the stability of the distribution. There are several theories about the dividend policy. The famous one is Modiglian and Miller theory, which is also called Dividend Irrelevance theory. It says that investors are indifferent between dividend and retention-generated capital gains. If they want cash, they can sell stock. If they don't want cash, they can use dividend to buy stock. So this is called a homemade portfolio or homemade dividend policy. But on the other hand, there is a theory called dividend preference theory, also a bird in the hand theory. So investors might think dividends are less risky than potential future capital gains. So they want to have the bird in hand to avoid their future risk. And also high payouts will help reduce agency costs by depriving managers of the cash to waste and causing managers to have more scrutiny by going to the external capital market more often. So therefore, investors would value high payout firms more highly and would require a lower return to induce them to buy its stock. Another theory is tax effect theory. So low payout means high capital gains. High capital gains tax are deferred until they are realized. So they are taxed at a lower effective rate than dividends. So this would cause the investor to require a high pre-tax return to induce them to buy a high payout stock, which would result in a lower stock price. So which theory is more correct? Some research suggests that high payout companies have high required return on stock, supporting the tax effect hypothesis. But other research using an international sample shows that in countries with poor investor protection, where agency costs are most severe, high payout companies are valued more highly than low payout companies. So in general, we can see that empirical testing has produced mixed results. Chapter 12 is talk about capital structure theory. So the structure theory, including the Managerial and Miller theory, and they have different hypotheses, like zero taxes, including corporate taxes, and the model incorporates corporate tax and personal taxes. Another famous theory is trade-off theory. Trade-off theory says if the company has high leverage or a lot of debt, it's going to increase the cost of equity and bearing a high bankruptcy risk. Signaling theory and pecking order theory. So the pecking order theory says the company gonna use their internal fund first and then issue bond and preferred stock. The last result is to issue an equity, because the equity issuance costs the most in the company. So other theory including debt financing as a manager constraint and windows opportunity. Thanks for listening. Have a great week.